So in this video, we're going to start in with our analysis. So there's three basic kinds of analysis, or comparison bases, if you will. Intra-company means we're going to look at our company historically. We'll look for trends, we'll look for basic performance that we expect the company to reach. Intercompany looks at competitors. We would like to know where we rank with respect to our competitors. From that, we might be able to extrapolate information into production, right? There's some things we might be able to find out about our competitors by looking at what they're doing and their results. And then finally, we can look at industry averages just to give us a point, if you will, to understand where the average company is. And of course, we always want to be performing better than industry averages. We always want to be above average. And certainly we want to be performing better than our competitors. There are three basic tools that we'll use: horizontal analysis, vertical analysis, and ratio analysis. These are the three primary tools. Now, some of these will even cross over a little bit. We'll see how that works as we go through some of the ratios. So let's go ahead and get started. Horizontal analysis. Think about horizontal, right? Something parallel with the floor. So essentially, we're looking at time. We're trying to identify trends, right? Is the company increasing or decreasing? Is the company's level historically? Has it been better than the industry maybe, or better than the competitors? But we're looking at a historical trend. Most of this is applied to the balance sheet and the income statement. So let's look at a balance sheet. So here we have 2022 and 2021. So we have the statements, right? And if you look, there is a difference. Now, unfortunately, I don't like the way this is set up, because it's not set up for looking at trends over a long time, right? Because this, maybe we want more years than this, right? We want to look at the last 5 years and how we've been doing. But essentially what horizontal does is it finds the difference, right? In 2021, we had 24.27, and in 2022, we had 27.17. So there was $290 more in current assets. So that is an 11.9% increase. We have an increase in plant and equipment, property assets. Total assets only increased a total of 6.4%. What about liabilities? Liabilities increased 2.6%. So some of the biggest changes, though, were in the equity accounts. If you notice, we issued some stock. Stock increased by 24%. Retained earnings, we've been profitable. It's increased 31%. Treasury stock, right? So this is a cost, right? It actually went from 912, it went to 1357. So that means what? It's an increase in treasury stock. That means we're buying back stock, right? Again, the change, it was a 50% change. So we've changed how we have been addressing treasury stock. And we may talk about this in other classes when you think about dividends and distributions to shareholders. So again, this is what we refer to as a horizontal analysis. So what do we learn from this balance sheet, right? Current assets increased to 11.9. Again, I basically went through this. Retained earnings increased 806,000. That's a 31% increase. So what can I do with this? Well, just having 1 year isn't necessarily the best information. As I mentioned, we probably would like to have more than 1 year. We like to have several years to see if there's any trends, right? Our current assets are up 11.9%. That really doesn't tell us anything other than they're up. But what was it? What was the change last year and the year before, right? Maybe we have a strategic plan that we were looking to increase the liquidity of the company. 11.9 says, well, we did it this year, but doesn't say we did it last year, right? So anyhow, looking at these changes is very important for understanding the operations of the company. We can do the exact same thing for the income statements. We notice the changes down here, right? If you notice at the bottom, we have what? Taxes actually went down, right? So we had income went up, but taxes went down. Not sure how that happened, but it does happen from time to time. So we would have to show that that is what? A 5.1% decrease in the line item, right? So net income actually increased 9.9%. Is that good? Sounds good. But again, what does history tell us? Again, just to kind of review that, right? Sales are up by 8%. Net income increased 9.9%. So gross profit increased by 7.3%. So there's somewhere we're thinking about some changes, right? So we know the what? Sales went up, but the cost of production went up. We had a little bit of an increase still in gross profit, but not as much as sales. So again, we can try to identify where the change is, where is it occurring in our financial statements, right? Vertical analysis, on the other hand, sometimes they refer to this as common size analysis, looks at line items on a financial statements relative to another number. So on a balance sheet, right, we want to show all of the assets or all of the line items on the balance sheet relative to total assets. So that's the base amount. On the income statement, we want to show how the line items of the income statement relate to sales or revenues. So let's look at this. Here is a condensed balance sheet, and this is, again, here's percentage. So here's total assets. Again, you take total assets divided by total assets, you get 100%. So 23% of the company is current assets. 26% is property and equipment. And if you look over here, it's pretty darn close. There's not that much change. Again, there's not much change in the dollar value. Let's look down below and see if there are changes down here. And again, we'll have a summary of this in the next slide as well. But you can see that what? Liabilities have decreased. Well, what does that mean? Well, it looks like here that what? We had $4,600 in long-term debt in 2021. Now it's $4,827. So we paid off some debt. There's also what? Some changes down below. So let's see what they summarize. We know current assets have increased from 22 to 23%. We have an increase in current assets. That could increase our liquidity. Property equipment have decreased from 26.3 to 26.2. Not that much of a change. Retained earnings increased from 24% to 29%. So that means what? We have increased the amount of funds that have been retained and kept by the company. What about the income statement? Again, I think this is one of the especially for managers, this is a very important statement to understand performance. Gross profit tells me how well I'm doing in production. So in this case, in 2022, gross profit was 44% of sales. The year before, that was 44.2%. So what does that tell me as a manager? It tells me that for some reason, cost of goods sold increased. Now, it didn't increase a lot, right? 0.2%. But I want to keep track of this. I would like to know how is this historically, right? I want more numbers so I understand, is this a trend, right? If this was much bigger, I might be a lot more concerned. Income from operations, or earnings before interest and taxes. 16.2, it reduced to 15.9, right? Well, what's going on? We're losing profit, 3/10. Not a lot, but it's something. Income tax, I think people find this to be the strangest, right? Income tax expense is 3.8%. That's not your tax rate. That's this number, 444, divided by the net sales number. So of every dollar that comes in the door, 3.8 cents goes to taxes. And in the end, again, we have what, 9.4% is the relationship of net income to sales, and that's an increase since last year. So again, we can look at this and summarize these statements, right? We need to understand, what do the line items mean? What does the relationship mean? And I'll have to say, this is not easy, right? When you're doing this for the very first time, this is not easy, right? For lots of reasons. Number one is confidence, right? Most students are not confident in what they have just learned. So they have difficulty expressing what they think they know. The second thing is sometimes students want to give instructors what they think the instructors want to know. And this is a problem, right? Because when you're thinking about an analysis, we're asking for your opinion, right? And your opinion cannot necessarily always be identified as being right or wrong, right? As long as there's some logic, as long as you understand why you're saying what you're saying, you kind of have to accept some of those answers. And again, here's for different companies now. So now we're looking at Chicago Cereal versus this company, Giant Mills. And what can we see? Well, look, Giant Mills cost of goods sold is 64% and ours is 56%. So we have what? We produce our products at a lower cost than they do. But on the other hand, look at this. Selling administrative expenses, right? The other expenses of running the company were almost 7% higher. So in the end, if you look at our income from operations, right? Total net, we're actually doing worse than them. Our production is much better, but overall running the company, we're doing worse. So how do we fix this? Would you go to productions and say, we have to figure out how to do this cheaper? Or would you say, why is this number so big, right? Relative to sales, right? What did we spend our money on? Is there a marketing plan? Research and development might be involved there. There's lots of things that could be in there. So in the end, we find out that even though production is doing really well, overall, our company is not providing the same level of earnings. And again, we have another little description here or a summarization of this, right? For me, the biggest point here is we are doing our production in a great way. We are having challenges with our selling and administrative expenses. We need to look at marketing, salaries, any of the other expenses associated with the administration of the company. We have to look at that and analyze, see whether we can do something there or not. So again, those are the first two kinds of analysis: horizontal analysis and vertical analysis.